When it comes to paying taxes, many people that owing as little as possible come April means that they've beaten Uncle Sam. Well, it's true that they may have won the battle, but with that kind of short-sighted thinking, they may not win the war, so to speak. The goal in tax planning is not only to pay fewer taxes in any given year, but to pay as little as possible throughout your lifetime. And sometimes that means paying more now to save later. Welcome back to the Retirement Fix, a monthly podcast for less stress and more success in your go-go retirement years. I'm your host, John Gigliello, a certified financial planner with the Albany Financial Group, and I'm here to be your guide to keeping more of your hard-earned money by making smart financial decisions in retirement. This podcast is for people nearing or in retirement who want to learn more about proactive tax planning, retirement income planning, Social Security timing, investment management, and asset preservation. After a life-altering health issue at age 39, my calling in life became clear: to share my knowledge of personal finance with people who are looking to make smart and responsible choices with their money. Today I'm going to talk about year-end tax planning strategies and why sometimes paying more, not less, can be the key to long-term success. Now, I like to say that most people are allergic to prepaying taxes, but it really does make sense for some people, in specific circumstances, to consider accelerating income and therefore pay taxes earlier than they might otherwise do. This is the time of year when I meet with many of my higher net worth clients for proactive tax planning. We examine their recent, current, and projected future income and its tax implications. We then determine what strategies might save them tax dollars now and in the future. Proactive tax planning is different from tax preparation and involves analysis that takes into consideration all aspects of a client's financial picture, with the results being unique to each client and their specific situation. Year-end tax planning accomplishes a couple of very important things. First of all, it helps clients avoid any tax surprises in April. By understanding their current tax situation in relation to the current tax laws, they can plan ahead for any liabilities by adjusting withholdings or making quarterly estimated payments. But a bigger part of tax planning strategy has to do with timing income such as IRA withdrawals and Social Security benefits to take advantage of low tax rates whenever possible. And that's what I want to focus on today. If you stick around to the end, I'll also offer a few tax planning tips that most people should consider before year end. The technique of timing income. Let's face it, taxes are unavoidable. You can't defer income forever, and Uncle Sam is always going to want his money. But planning early can help you decide when it's most advantageous for you to pay taxes on certain income. When required minimum distributions kick in, many people face a spike in taxes owed due to the additional income that sometimes forces retirees into higher tax brackets, triggering the Income-Related Monthly Adjustment Amount, or IRMA for short. These surcharges subject more of their Social Security benefits to taxation. But what if they prepaid some of that tax during years when they fell into a lower tax bracket? Let's look at a simplified case of fictional clients Jack and June. They are 62 years old and in their early retirement years. They are collecting pensions representing just a fraction of their former salaries, and they are not yet collecting Social Security or subject to required minimum distributions from their IRAs. Due to these new circumstances, their income is as low as it has ever been, and therefore they fall into the 12% marginal tax bracket. This bracket is lower than when they were working, and it is also lower than the bracket they believe they will be in when they start collecting Social Security and RMD payments on top of their pensions. A look at their financial plan with tax planning in mind shows a few ways they can take advantage of their current low tax bracket. Number 1, Jack and June may consider delaying Social Security until they reach full retirement age. This gives them a few years of lower income and lower tax rates when they can begin taking withdrawals from their IRAs. They are not required to take withdrawals, RMDs, until age 73, but they are permitted to do so penalty-free after ages 59 and a half. By taking withdrawals now while their overall income is low, they pay taxes in their current lower tax bracket. This strategy may also reduce the amount of RMDs they will need to take later by partially drawing down on their accounts now. Number 2, Jack and June might further be able to take advantage of their current low tax rate by performing Roth conversions. By converting traditional IRA dollars into Roth IRA funds, Jack and June will pay taxes on the amount converted as if it is ordinary income this year. But in the Roth accounts, the money will continue to grow tax-free and never be subject to RMDs, as long as certain requirements are met. This tax planning strategy may also benefit their heirs. When beneficiaries inherit Roth IRAs rather than traditional IRAs, they still have to take RMDs, but the withdrawals are tax-free. Alternatively, when traditional IRAs are inherited by non-spouse beneficiaries, they often become subject to a 10-year distribution rule, causing large, unplanned spikes in income for the beneficiaries. Surviving spouses can avoid the 10-year rule, but they may still experience a jump in tax rates when they begin filing single and still need to take RMDs. Number 3, if Jack and June's income is low enough, they may be able to take advantage of the zero rate of investment income. In 2025, married couples filing jointly with taxable income below $96,700 and singles below $48,350 owe zero tax on investment income like long-term capital gains and qualified dividends. If they have a concentrated position of stock in a non-qualified account or non-IRA that they wanted to sell, this would be a very good time to consider it. Even if their income is not low enough for the zero rate, they could sell it over 2 or more years to keep the tax rate lower in each year and avoid a 3.8% surtax. These examples are just options to be considered in conjunction with a client's overall financial plan, and this is not intended to be advice for any one individual. A few other ways tax planning can help you time income include funding Roth accounts during lower income years. This strategy is suitable for people who are still working. Dollars going into these accounts are after tax, so there's no tax break on contributions, but growth and withdrawals can be taken tax-free, and there are no required withdrawals for the original owner. Funding Roth accounts makes the most sense for savings when tax rates are lower on contributions than they would be on future withdrawals of those same funds in traditional IRAs. Many employer retirement plans also offer a Roth option. Carefully planning withdrawals from inherited IRAs. As I mentioned a moment ago, most heirs of traditional IRAs who aren't spouses have to drain the inherited accounts within 10 years. They also have to take minimum withdrawals annually if the owner was required to take them. These required withdrawals are likely to be low, however. Tax planning can help look ahead to determine if it makes sense to accelerate the withdrawals to prevent an income surge in the 10th year that could raise their tax rate and trigger other levies. Of course, year-end tax planning encompasses more than the question of timing income. Other areas we examine include tax loss harvesting. Investment losses can be used to offset any gains you've realized in the same year or up to $3,000 of income. You might consider selling depreciated securities that no longer fit your strategy, have poor prospects for future growth, or can be replaced with similar investments that play a similar role in your portfolio. Contributing to a tax-advantaged account. Contributions to a 401k, 403b, or health savings account could potentially lower your taxable income for this year and increase the assets you have available for future retirement and medical expenses. It's good practice to review your contributions before year end to ensure that you're taking full advantage of the limits for these accounts. Maximizing your charitable deductions. Many people look to support nonprofit organizations, particularly near the holidays and year end. Giving is inherently rewarding, but you may also want to consider ways to give tax efficiently. If you itemize deductions, remember that up to 60% of your adjusted gross income, AGI, can be deducted for cash contributions made to qualified charities in 2025. Qualified charitable distributions. If you are age 70 and a half or older and have an IRA, you may want to consider making direct transfers of up to $105,000 or $210,000 for married couples filing jointly from your IRA to eligible charities. Donations made as QCDs do not count as taxable income. One of the services I offer high net worth retirees is proactive tax planning. We review anticipated income from all sources each year and employ strategies to help clients make the most of their hard-earned money. If this sounds like something from which you could benefit, reach out to us. You can find more about the services we offer at www.jgigliello.com. And don't forget, we always encourage you to take part in the financial planning process to pursue a confident financial future and, in turn, feel optimistic and proud about your accomplishments. If you've diligently saved over the years and have accumulated investment and retirement assets, and you understand that the success of your retirement is too important to be managing yourself, and you value experienced and professional guidance, feel free to give us a call for a complimentary initial consultation. Knowing that I've provided education and a plan for my clients has allowed me to turn a personal challenge into a gratifying journey. If you found this helpful, share this episode, and don't forget to subscribe. If there's a financial planning topic you would like us to address on a future episode of The Retirement Fix, please reach out and let us know. Otherwise, thanks for listening and make it a great day. Information for this episode was derived in part from a February 2025 Wall Street Journal article, "When Paying More Tax, Not Less, is the Smart Play," and from a Fidelity.com article, Year-End Tax Planning Tips for 2025, dated July 2025. John Gigliello is a registered representative with, and securities are offered through LPL Financial, member FINRA, SIPC. Investment advice is offered through Private Advisor Group, a registered investment advisor. Private Advisor Group and Albany Financial Group are separate entities from LPL Financial. The opinions voiced in this material are for general information only, are not intended to provide specific advice or recommendations for any individual. Albany Financial Group and LPL Financial do not provide tax advice or services. Please consult your tax advisor regarding your specific situation. Traditional IRA accounts have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you are required to take a required minimum distribution, RMD, in the year you convert, you must do so before converting to a Roth IRA.